This is Mark Phillips, and my colleague Ed will be speaking. Ed Lane will be speaking later in the session. So we're splitting this session into two parts. The first session is going to cover preparing for a sale, the lead up to the sale, which is absolutely critical because it can actually make a huge difference to the actual sale, and in particular how much you're going to receive when you finally come to do the sale. I think it can also maintain your sanity if you've done a bit of good preparation ahead of the deal. Just by way of introduction, we're from Harbottle and Lewis. We're a preeminent firm in the tech, media and entertainment space. We've had a games department going back to the NES Master System days, even before actually, and we've kind of evolved as the industry has kind of evolved, and we act right across the industry for very small startups to huge multinational publishers, console companies, etc., and pretty much everybody in between. We as a firm also have lots of backup. We have a specialist music department, film department, sports department, as well as the sort of traditional legal disciplines like property, tax, IP departments, obviously a corporate department. The corporate department, it's clearly been a very busy, frothy few years for the games market, particularly the last 18 months and particularly during lockdown. I remember sort of seeing a deal every 3 months, 2 months maybe in the game sector. I'm now seeing inquiries on a regular basis. I mean, you just have to pick up the press or look at online, and you're seeing deals almost on a daily basis in the last 12 months because of where the game space is. And obviously others later today are going to be talking about that. That's meant that we've been very busy. I think we've done about 10 or 12 deals in the last 18 months, ranging from the huge ones. We acted for Take-Two when they were bidding for Codemasters. Although they didn't succeed, they were picked by EA. We ended up doing all the work as if they had done it, including making the formal bid, right down to acting for literally smaller startups when they're raising seed financing. Obviously, we very much like to take our clients on that journey from when they're starting up right through until they're extremely successful and, hopefully making acquisitions themselves. But many of our deals are also acting for entrepreneurs, founders, institutions, even corporates that are selling divisions. And this talk primarily is going to focus on the sale aspect. And what I want to cover is how do you know when you're actually ready to sell? The second point is, what do you do before the deal's even on the horizon? Make sure you've got your ducks in order. And finally, maybe the most important point is always have a plan B. I'll come back to that in a minute. What I should say is that I think for the purpose of this talk, we're going to focus mainly on looking at the deal from the perspective of the seller. But it's absolutely key that we keep in mind where the buy is coming from, because if you can do that, it will iron out some of the bumps. It will make for a much better relationship post-deal. And more importantly, it means you'll probably end up getting the best deal for yourself. The other thing I should mention is games businesses come in many forms, many corporate forms. It could be a partnership, it could be a sole trader. I'm actually going to focus mainly on the sale of shares, and Ed will do the same later. Bear in mind that there are alternatives. We're talking here about exits, and I think some of the talks later talk about other alternatives to a sale, such as an IPO, for instance, or an MBO, etc. And I'll leave the others to explain that. But I think certainly in our experience, the ones which are most likely to be relevant to people on this session, I think is a classic sale. Okay, and that can either be what's called a trade sale, sale to someone in the industry, or it could be a sale to a financial buyer, like a private equity house, for instance, by way of example, or a financier, or somebody from completely outside the industry who's trying to access into the industry. So how do you know when you're ready to sell? And I think that the first question I think I would ask in your position is, why are you selling? And it may seem an obvious question, but actually, I think it's one that when the clients come to me first, it's the question I always ask. I also always ask the buyer, because once I know the answer to that, I can help structure what is most important for either the seller or the buyer. So if you're a seller, what are you looking for? What is it? Well, firstly, obviously you want a payday. You've built something up, you've created value. Now's the time to sell. But be aware that you may not always get your money up front. It may be payable in installments. If so, think about what kind of security you're going to get to ensure that the buy doesn't go away. Make sure the buyer's got sufficient assets to effectively be secure enough to pay you, because it's in effect, if you're being paid in installments, you're effectively lending the purchase price back to the buyer. And obviously, even if the buyer is able to pay, it may not want to pay for whatever reason, and possession is 9/10 of the law. So just bear that in mind. It may seem to you like once you've sold, it's the payday, but it may not. The second most important point is many deals, when they're particularly games businesses, when they're valued clearly not just on the current value, but on the value over the next 2 or 3 years. There may be a key product coming out, and you as a seller want to share in the actual success, not in what people assume is going to be the success and discount it. You want to see the actual value, and the way that that's achieved is through what's called an earnout, where the price, part of the price usually, is contingent on the actual ongoing performance of the business. So another consideration is possibly you want to take the business to the next level. You want to team up with a strategic partner, and actually the best way to do that is through a sale, in which case you're probably looking at an earnout because you're looking at the future. I would say, as an alternative to that, think very hard about alternatives, possibly investment, possibly finance, possibly some kind of strategic deal whereby a third party may take an option over your business, etc., or they may, do some sort of licensing deal or whatever. But you maintain control so as to build up additional value. Of course, other obvious reasons for selling is that you could be running out of cash. And the reason I mention that is always predict, always forecast. You should be operating on very good cash flow forecasts anyway. And if you can see that cash is going to become a problem in 6 months' time, obviously take action as soon as you can ahead of that, because what you don't want is effectively to have effectively a fire sale where you've got your back to the wall and you're forced to sell, and you're going to get not only the worst, if any, price, but you're going to get the worst terms. So plan ahead. But there are other reasons to sell, like succession planning, etc. So be clear in your own mind as to what you're looking for if you are selling. But what's the buyer looking for? And this is particularly important if you're a seller, because if you know what the buyer is looking for and what's important, you can affect it, particularly in advance of the deal. You can position yourself so that you're most attractive, dare I say it. So the buyer could, obviously in the games business, particularly if they're buying a studio, they're going to be looking at talent, at people on seats, frankly. Okay, they're going to be looking at IP, obviously. They're looking at the tech, any particular know-how that's in the business, also any particular relationships the business has. licenses, you know, sports licenses, which are absolutely key, which effectively tie up the sports market, if it's a sports franchise, for instance. So effectively acquiring contractual relationships. The buyer could be making an acquisition for defensive reasons. They want to stop their competitor buying the business that you're looking at. You want to ensure that no one's going to work with that business in future. Okay. You, in particular, though, as a buyer, you're going to be looking at buying the earnings and buying the turnover. Okay. And many businesses are valued not only on an assumption about their assets and liabilities, but actually on what's called a multiple of earnings. And what that means is the buyer will look at your profitability and, as importantly, your projected profitability, and they will say, okay, we are prepared, we project that those earnings, those profits to be, let's say, 5 million, and we will pay you on the anticipation that we are going to earn those earnings from you, okay, and the rest. And so we'll do that over a period of time, and let's say 5 years, in which case it would be a 5 times multiple. Quite frankly, that's a very low multiple in the games business at the moment, where we're seeing multiples, you know, maybe starting at 8 times, even up to 20 times, etc. And the key point for the buyer, particularly if they're a company that's listed already and where its shares are valued on its multiple, or more importantly, in many respects, where they're hoping to go public or to sell in a few years' time, and they know what multiple they're operating at. So if they can buy you at, say, an 8 times multiple, and they're being valued at a 20 times multiple, the same profit of 5 million is worth significantly more for the buyer. That's a bit of financial engineering. Maybe I'll leave for one of the later speakers, but it's a key point in bearing in mind. And as I say, most games businesses that we've come across recently have been sold on a multiple of usually profits rather than turnover. So the next point is, be very, very clear what you want from the sale and how it's going to change the status quo. And again, maybe stating the obvious, but once you've sold control of the business, you're no longer in control, obviously, okay? But what that means is, I mean, I've had situations where, as the deals got very close, literally on the day of completion, I've had sellers literally, it's not even buyer's remorse, it's seller's remorse before they've even done the deal. They're regretting it. It's almost like giving up a baby. These people often are, or yourselves, your founders, you put your heart and soul into the business. It's your baby to a certain extent. And in many ways, you're giving away that baby. I've actually seen grown men who are about to receive a huge amount of money in tears on the day of sale before the deal happens, because it's almost the sense of this realization that they are giving up their most treasured possession in some respects, you know, depending on their sense of priorities. And it also, in particular, they're not going to be in control of their own destiny post-deal. That is the key point. Most buyers will want, particularly in games businesses where the sellers are often integrally involved in the business, they're going to want them to stay on in the business, okay? So yeah, sure, you're going to have the financial carrot, but there are other downsides to doing the deal. So a sale may not be the only goal. So what kind of sale are we talking about? I'm sort of aware of time, so I'm going to go a little bit more quickly. Well, firstly, what is a business? A business is a list of assets, you know, it's assets, it's its IP, it's the people, it's its cash, it's its debtors, etc. But it's also its liabilities, okay? And so one of the key points up front to think about, and certainly the buyer will think about this, is whether they buy the shares in the company, i.e. the whole shooting match, or whether they're going to buy certain assets, okay? And from a buyer's point of view, they particularly like buying particular assets, because they can cherry pick the assets that they want and they don't have to pay for those they don't want. But more importantly, they only have to take on those liabilities that they know about and that they're comfortable taking on. Okay. Equally, there's tax and accounting considerations as to why a buyer might push for not a purchase of shares, but the purchase of assets. From a seller, certainly in the UK, if you're a UK taxpayer, almost invariably you will want to do a share sale. One, it's a lot simpler for you. Two, you're not left tidying up things post. Three, the cash goes into your bank account, not into the company's. But fourth, it's most tax efficient that way. At the moment, we've got capital gains tax at 20%. If you're making your first 1 million of gain over a lifetime, you have something which is now called business asset disposal relief. We used to know it as entrepreneurs relief, where the tax rate is 10% on the first 1 million of lifetime gains. That is incredibly tax efficient, means more money goes into your pocket. It means that probably 90% of deals at the moment are done in the UK as share sales. That may change if the Chancellor changes the tax rules, which is what people thought was going to happen earlier this month at the time of the budget, which is why there was a plethora of deals in the UK just before then, because people were trying to sell before the change of tax rules. But at the moment, those rules are not changed, possibly will change later in the year. So before there's even, before we do the deal, what do we need to think about? Okay, and in particular, you're looking at, where does your value lie? IP, people, your tech, etc. But let's start with the people, because in my view, certainly when you're talking about studios, they are fundamentally games businesses, but more importantly, people businesses. The people are the assets. In days gone by, I remember businesses being valued by reference to how many bottoms there were sitting on seats. Nowadays, it's a lot more sophisticated, but employees and retaining those employees and incentivizing them for the future is something you need to be thinking about prior to the deal. Because if you don't, and if you haven't looked after the employees, besides the fact there's a risk of employees walking out, which clearly devalues the business, more importantly, there's less chance of the employees remaining with the business. And so the buyer will discount immediately. Okay. Most times, most sensible sellers will give their staff a bonus. But for those, the best way of incentivizing and in fact retaining staff is often through share option schemes, which is a talk in itself. But in effect, the key message to get across is don't leave it too late to set up such a share incentive or option scheme, because otherwise the tax ramifications can be very disadvantageous, not only for the employee, but also for the employer. So that's a bit of housekeeping you should do up front. Equally, you want to ensure that on the deal itself, maybe don't give the staff too much of a payday, because otherwise it means the buyer has got to incentivize them in future and will basically possibly discount the price as a result of that. The other aspect ahead of a deal is obviously to check that you actually own the assets that you think. Your IP is the obvious one. If you've used freelancers, as you probably know, you need to assign across all the IP that they've created, otherwise they own it. And other aspects are, consider if you've got any contractual provisions which could muck up the deal. For instance, if you've done a deal with a publisher, the publisher may have a right of first refusal, which could depress the value. It could put off many potential buyers because they'll see themselves as stalking horses and they won't be prepared to kind of get involved in the time and expense. So really leading towards the conclusion, you need to get your ducks in order to make sure that it is a frictionless process. You need to look under your own bonnet, fix those issues. If you've got an office lease which is about to terminate, sort it out now. If you in fact want the property to be moved out of the company so that you own it and you lease it back to the company, do it way ahead of the deal, okay? You should, as important, consider if you want to keep back part of the business. For instance, you know, you may have created some really interesting bit of tech that has applications beyond the games business. You may want to hold that back. You may want to hold back the brand. It's what Virgin did. It's what Easy did, okay? And then you create it and use it for different purposes. You may even hold back some underlying tech. You'll need to then set up arrangements with the parts of the business that you've retained, with the parts that are going, with the parts that are being sold. And those kind of intergroup arrangements are best to be done up front, not to leave it to the last minute where the buyer will be all over it. And effectively, you'll have a lot less flexibility. I think the final 2 points really to mention in preparation. One is tax. I can't emphasize that enough. I think others will be talking about that later. Tax planning is key, because if you leave it to the last minute, often you won't succeed. And two, it will very much disrupt or potentially disrupt a deal. And again, it will backfire on you. Be aware the buyer is going to do due diligence, which Ed will talk about. And what that means is they're going to do their homework ahead of the deal. Be prepared for that. Be ready, so you are absolutely ready to open your bonnet and show what the buyer's going to be buying. Finally, and this is the very final point, always make sure you've got a plan B, if only for your mental sanity, because many deals don't happen for all sorts of reasons. But best reason for it is that if you've got a plan B, you're not desperate to do the deal. And if you're not desperate to do the deal, you'll get the best deal. Thank you very much.